Awesome. Welcome, everybody. Happy Friday. You guys look like you're ready to start your weekend already, but thank you for giving us 90 minutes of your Friday. Super excited to go through our market report. My name is Johnny Christensen. I am the state director for Keller Williams, and I'd also like to introduce my official co-host, Marcus Green. Welcome, Marcus.
Thanks for having me. Hey, everybody.
So excited to tag team this market report. I know you do this consistently every quarter. So if you're new to our Zoom today, we go through this every quarter. We try to shove as many points of data and slides into your brain as possible. We usually journey through about 150 slides in about 75 minutes. So again, thank you for being here. I'm assuming many of you have been on the quarter market report, but if it's your first time, thank you for jumping on. Marcus, anything else before we get rolling?
No, I think there's two sides to this conversation. Every time we look at statistics, one, it's making us more knowledgeable on what's going on in the market. But what we can't do is just consume the information and pat ourselves on the back and say, oh, I better understand the market. The whole point of this is to understand the market, forecast what's going to happen, make the changes within our business to match the market. And then also, what is the story that we need to be turning around and telling our consumers, the clients? Because I'm a big believer that our people are in a bigger state of confusion and uncertainty ever. So I would just encourage everyone, as we're talking, there's going to be 2 or 3 bullet points that stand out to you. And then I would ask yourself the question, all right, well, now how do I take that as in the form of an answer to my client who's probably having this question somewhere? So let's take some action after we talk about this today and grow our businesses and connect with our people.
Yeah, and the last 4 quarters has been crazy, right? We were humming for several years there for a little bit. Obviously, the last half of last year got a little funky, but even seeing Q1 data has given us a lot of optimistic points. And always huge shout out to our regional operations manager, Gordon G. Payne. He is our economist of choice. He's the one that spends many hours putting this data together. So we appreciate him like always.
Is G. Payne his rapper name?
That is his, yeah, he's a rapper / DJ. So yeah.
G. Payne?
If me and Marcus get stumped, we usually ask Gordon for some of his wisdom because it usually supersedes ours. So thank you. And let's get rocking. So again, here's just a quick snapshot of what has been going on year to date. So this is compared year to date on here on the right columns. Year to date, the first quarter of 2022 against just what we went through the first quarter of this year. You can see new listings have dropped. Less listings have came on the market, down 18%. Pending sales, basically under contracts, are down 20%. Closed sales, this is usually the story of what's going on in our marketplace. Just less homes are closed compared to the first quarter, even first half of last year. 24% down. Days on market, right? Days on market has gone up as those rates went up. A little less buyers going into the market, but up 146%. Median sales price, we've seen that decrease. We'll go through some of the pricing across the country and the state of Utah, down 7%. This is a little anomaly just because we only have 3 months of data on this, but the percent of original list price, when it lists, what does it actually end up selling for? We're down 6%. Housing affordability will be great to go through, but we're down 11%, just slightly less affordable as the rates are floating around the 6s. Homes for sale, 180%, and then month supply, no doubt's up, but is it really that much up when you talk about 2.6 months? But we're going to go through all these. So me and Marcus will navigate you through a lot of this data. These are we're going through a couple big sections. We go over these main 5 sections. We go over construction data, investment data, some of those other categories. But let's hit these 5: home sales, home prices, months of inventory, mortgage rates, and affordability. And again, just if you are new, we always jump back and forth between the United States data. Gordon pulls data from 70, 80 sources now just to get the most relevant data, depending on what stat we're talking about. But we jump from the United States to Utah. So we'll be going back and forth. But here is home sales. Last 2022, we ended up around 5 million homes sold in the country. We always say 2 sides to each deal, so about 10 million sides of commission for agents. But 2021, a little post-COVID run that we had there was 6.1 million homes sold. But 2005, what year did you get in the business, Marcus? Somewhere around there, 2005?
2001.
2001. So you enjoyed some of these heyday back then, but here's monthly. So you can see at the end of last year, 2022, this is rolling 12 months. So November and December, we got down to 4 million homes sold on a rolling 12. But then we popped back up a little bit the last several months, but 4.6, 4.4 million homes sold. Projections I've heard anywhere from 4 to 4.4 million homes sold in 2023. But again, when Marcus and I were sitting in family reunion, this is one thing that Gary pointed out. We're still projected to have the third best volume year in real estate history. So again, if you look at that $2.13 trillion of volume sold in the United States, even though those units have dropped because purchase price has gone up so many of the last several years, still a very healthy 2.13 trillion, which is a month pay for Marcus. Just kidding.
One thing to note too, if you notice back a couple slides where it showed kind of grouped into the 2002 to 2006, 32.2 million sales versus the 27.3 over the last couple of years, is the population difference at that time too. In 2000, there's 52 million more Americans in 2022 than there was in 2002. But you look at the number of closed sales as a accumulation, they're much higher, but from a volume standpoint, we're significantly farther down the road in the last 5 years than that pocket of time, even though there was more closed sales before. It's just interesting to see.
Yeah, good point. And comparing that to what's happened in Utah the last couple of years, we peaked in 2020 with 60,000 homes sold in the state, 55,000 2021, and then last year we dropped down to 42,000. You can see that 20-year average floats right around that 43,000 homes sold number, which we were a 24% decrease from 21 to 22. But then here's on the rolling months, you can kind of see January, February, March felt a lot more of a normal month. But you can see basically, Gary says, if it felt like we fell off a little cliff the last 6 months of last year, we kind of felt like we did, right? And you can see some of those numbers in comparison with 21 and 20, but 2,600 homes sold, 25, 2,800 those last several months. But let's transition to home prices. This is usually what hits headlines a lot more than other categories. But this is the median home price across the United States. So not average, this is median, which is a very fair median price out there. We are year to date in the country, 366,000. Last year, we peaked at that 383,000, 347 before. But if you're unfamiliar with this yellow line is what we call the long-term average or the trend line, which is a 4% baseline appreciation per year. That is what we consider a very steady and its ability to be consistent on appreciation. So pre-Great Recession, you can see how far above that trend line we got. We peaked at 21% above that trend line. Great Recession happened. A lot of you remember that. We fell below that line. There was talk that we may never actually return to that same trend line and we could have created a new trend line. But again, we actually did get back to that trend line and surpassed it the last 3 years. We stopped at 12% above the trend line at 383,000. And then you can see kind of how that flew throughout the months. And this is something Marcus and I talked about yesterday. Last year, we peaked on median price in the United States around June of 22 at 416,000. That was the peak. We have since been declining up until January of this year, went all the way down to 359,000, which the last 2 months, February, March, we're back appreciating. So we have jumped up about what? 16,000 median price, but then you can see that overlap of interest rates. Those 3s and 2s all the way up to about 6.5 right now as of last month. And this is the rough part when we're representing buyers, right, Marcus? This is the median home payment, principal and interest with a 20% down. So this is basically the median home payment across the country. So if you take someone that is buying a median purchase price home with 20% down with the median mortgage rate, this is the median purchase, the monthly rate. So $1,907 is what we just ended last month at. That is the median payment. 2021 was all the way down at 1,170. So again, when those rates go up from 3 to 6.5, you can see how tremendously quick that could affect our median price, which is no doubt driving our affordability.
Yeah, I think it's really interesting. And to me, this is probably going to be the biggest determiner of what happens with our market moving forward. Is if you compare back to like 2009, 2010, 2011, when prices were declining, we see a price decline now, but the reason of the decline is different. In 2009, 2010, 2011, buyer demand was diminishing because people's certainty in real estate was diminished, right? So the way I look at buyer demand today is I kind of split buyer demand into two pieces. There's buyer desire, which I think you guys would agree, there's still a lot of buyers that wish they could be buying right now. Like the buyer demand from a desire standpoint is high. It's the other half of buyer demand is buyer ability. And that's where a lot of them are not being able to execute, is their ability to execute has diminished. Their desire remains high. And so this is where somehow that's got to find a balance for our market to pick up and for sellers to come to the market, is those buyer ability to be able to execute, buyer desire remains high. We need that inventory to come in the market. But it's really interesting, again, to look at this, the amount of what it's going to cost someone to buy a home and maintain a home now across the US. When we look at this compared to Utah here in a second, it's significantly higher even.
Well, and who this hits the most, right, is our first-time home buyers. Depending on the marketplace, you're usually anywhere from 30 to 50% of buyers are first-time home buyers. And when the payment spikes this fast, this rapidly, it's just priced so many of those first-time home buyers out of the market. I've heard anywhere from like 50 to 60% of our population have been priced out of the market because of just those interest rates and how far prices gone up. So we tried to put in here a Utah very comparable slide from what we just went over with the United States. So you can kind of see, here's the median home price in Utah. We're at year to date, 466,000 median price. We peaked at 510,000. We started that trend line, that 4% trend line when Gordon built this data, the same time that the United States one started. So it's sort of comparable, but obviously Utah's such a small market compared to the median appreciation across the whole country, with markets booming, markets staying stagnate, some depreciating. So it might not be as solid of a trend line, but it's still a very good piece of information. So the biggest thing that stands out, again, is that circled 67% above that trend line, which basically means we appreciated faster than the United States, which has made it a little bit more difficult on affordability here. If you remember on the US graph, that's 67% here for Utah. It was 12% nationally. So it's no surprise to any of us that we appreciated at a faster pace. The only comment I would make about that graph that I'm curious to see is who we are demographically as a state in 2020, 21, 22 is significantly different than who we were demographically in 2003, 2004. So there's a part of me that wants to say, like, somewhere in that 2013, 14, 15, I almost want to slice that yellow line and shift it up because the type of jobs and everything we've attracted into the state, it's changed demographically who we are as an economy that I don't think will change. So I'm curious to see if we're really 67% above a trend line that we should be based on who we are as a state now. Well, obviously we got better looking, so we deserve to live in higher priced houses. But unfortunately, those are the people moving into the state. Those of us living here didn't get better looking. Staying Californians. So here's Utah month by month. So you can kind of see similar trend, which is what Marcus and I, again, were talking about yesterday. We peaked actually a couple months earlier in April, May at that 535 median price. And then because of those rates rising and a few other things in the economy, we've been dropping our median price since basically till January. We ended up at 455. And again, the last 2 months, we've seen an appreciation in that price. So I guess the question you would ask yourself is what Marcus and I talked about. Did we hit the bottom potentially in that December, January as far as pricing goes? Which, both of us kind of believe we did. We would have to see something new kind of come into the market potentially to change that. Particularly in that under million price point, right? Yeah. Mm-hmm. Like the luxury market's a little bit of a different game, but agreed. And commercial, right? Commercial's looking for a little pessimistic next 12 months too. But here's the payment, right? So you look at our median payment as of the end of March was $2,717, which is a full $1,200 more than we were in 2021. because again, higher purchase price, those rates going up almost felt like it doubled the payment for some of those borrowers. But here's exactly what we were talking about, the comparison with United States and Utah. We were pretty close all the way till 2015. And again, even the United States early 2000s, they had a higher median price, which is weird to think, than Utah did. But again, just the last basically 5-6 years, that gap has just dramatically separated. We climbed a lot faster, higher. But even look at our correction from where we ended 2022 to year-to-date 2023, we corrected a lot faster. So hopefully we've seen that potential bottom maybe sooner than the United States. But here's just an overall appreciation on an annualized basis with just a flat percentage. 2022, we grew 10% appreciation, 18%, 9%, 5%, 5%. We probably averaged somewhere around that 7-point-something% over the last decade of appreciation, which again, when you're comparing that to 4%, seems slightly unsustainable. And here is Utah, which again, if you average those out the last decade, we're probably more like 10% average appreciation over a decade, which it's been fun to own real estate, but that's probably caused some of our affordability challenges. So let's now pivot to inventory. And again, inventory's gone up, but here is, when Marcus and I were out selling houses back in the old buyer's market days where you'd have one buyer and you'd have 100 houses available to show each buyer. Spent a lot of money on gas back then, but clearly we got really down 2021, 2022, but across the country, year to date, we're at 3 months of inventory. And again, that trend line's balanced 6 months. So anything below that, we consider a seller's market. Anything above that's a buyer's market. I feel like we're just barely getting into my sweet spot. That 3 to 5 months, I think, is probably my favorite inventory level.
Agreed. I think where the Fed establishes that 6-month line, to me, that's too high. Again, that 3 to 5, to me, is like a great playground for us to win in as agents. Good market moving. It just is a healthy place to be.
Yeah, we climbed up to 3.5 months at the end of the year in the country. We got down as low as 1.7 a couple times, 1.6. But you can see already the first 3 months of this year, we're already decreasing our inventory. And then here's just U.S. pending home sales index by year. The index is basically 100. So as it goes above that line, we call that the home sales are expanding. If it's below that, they've been contracting, which we clearly know. But here, let's look at this one. So this is U.S. new single-family housing units completed in the country. So we'll look at some different construction slides. But basically that blue bar graph is new units completed. Those are thousands. The numbers are in thousands. So it's basically in the millions right here. But 15 straight years below the 52-year average of housing units completed. That whole Great Recession, so many builders either went out of business or kind of got put on the sideline. We kind of created that gap of the number of homes that were underbuilt in the country. I've seen many different stats, but I still think it's probably somewhere around 5 to 7 million homes underbuilt in the country. And last year was really the first year that we finally went right at that trend line of housing starts.
And again, the thing that's difficult with that yellow line being the average is our population is also significantly increasing over that time too. So obviously more population, more households needed. So not only were we behind already, but also adding additional population on top of that it takes some time to catch up, particularly if you had that drop off in 2008, 2009.
Yeah. Coincidentally, my partner Clay booked a meeting for us with a capital group coming out of Japan. You've probably heard of many builders in the state that have been purchased by big Japanese companies. And it was funny to connect the dots with the two of us on just kind of why that happens. But Japan's population has been decreasing for several years. So you think about what that does to a country, and specifically being in the business of builders. Building new homes for a country that's shrinking is not a great business model. So for almost the last decade or longer, these Japanese builders have been trying to go find other markets that are growing to do that, which you're going to continue to see some of these decreasing countries that are going to kind of move to the United States to go get on our growth trajectory still. Here's the showing index. There's clearly some seasonality in this, but this is kind of just gauging the number of showings that the average home receives. The index is at that 100 level. You can see winter, we tend to drop a little bit. Then springtime, summer comes out, we start popping again. But either way, the last couple months, we've been going back up, which is great that our inventory is getting trafficked, which may even drive the inventory down a little bit lower, which is the reverse side of that. But let's talk about Utah and their inventory. So we year to date, we're at 2.6 months of inventory. 2021, you can see over the whole year, we averaged 0.9. But this is what tells the story, Marcus. It's just that, look at all those below 1, even below 2, but below 1. How many times did we have agents come to us and complain to us that they were burnt out because of the speed of the market, the competitiveness of buying a listing? But that's the story. And to be honest, if we can stay away from under 1 month of inventory, I think our agent population will be a lot happier. But again, the last 3 months, we were right there at 2.6 months of inventory.
Which is still based on, we have very short memories, right? We think that the market of yesterday was normal. 2.6 is still incredibly healthy. Like it's obviously trending in a way that could get us into a little bit of a bind, but we still have this gap that it needs to go through. That's still a very healthy market.
Yeah. Yep. Here's new listings. So this is all the listings that came on the market in a year. We peaked kind of that 18, 19 years, almost hitting that 70,000 listings. Last year was still 60,000 listings came on the market, which is a slight reduction from 2021. We're probably going to be somewhere around there, maybe even slightly under that number in 2023, in my opinion. But here is just the month to month. You can see March, we had 4,100 come on, 3,600, 3,400 the month before. Not terrible numbers, but that's setting the pace that we're going to have less listings that came on the market in 2023, unless we kind of have a huge summer, spring to catch that up.
The challenge there too, is, as we all know, is a lot of sellers are also buyers. And they're running that same thing, buyer desire. They want to move, they want to change properties, but they're looking at it saying, I've got equity in this home. What would my payment be on the other one? We've got to figure out, we got to help coach them through a solution on how do I sell this home and move into what I want in a financially responsible way in their mind.
Yeah, because going from a 3 to 6% rate is causing some of those sellers just to stay hunkered down into their house, but also builders, land sales have slowed a little bit. The instability of the builder market. But again, this is kind of just throwing some gasoline on the fire of our lack of inventory or the housing units that we need to be built. So hopefully this is kind of a good trend that we're going to get back to. This is month to month, so you're going to see some swings on this, but this is percent of new residential listings sold. So out of all the listings that come on the market, what percent sell? You can see last month, 76% of listings came on the market sold. Some of those that go over 100%. Clearly, they're just selling some of the inventory for the month before. Just another way of kind of looking at the trend of that. But here is homes for sale. So at any moment, active listings on the market. If you pulled it up when these numbers were pulled up, 19-year average at any moment in the last 19 years, on average, there was 18.3 thousand homes in the state of Utah for sale at any given moment. You can see how far above that line we got in 2008. When I talk about a buyer's market, imagine having 33,000 listings right now in the state of Utah active. When you pull up the MLS, we got down sub almost 3,000 for a little time period. But even just last month, we ended at 8,463. But again, this isn't just the UtahRealEstate.com. This is all MLSs all across the state that UAR polls. But here is kind of the trend line on homes for sale. So you can just see just the difference from that 0.6 months of inventory to even 2.6 months of inventory, a lot more healthy of a number jumping there. But even just look at, the yellow, kind of a little bit of the COVID where people didn't know what was going on. You see a lot of the higher numbers right around those COVID times.
Well, even if you go back 2 slides, that we call that a high number on that graph, but you look back, a lot of us had some of our best real estate years ever, 2017 to 2020. And you can see it bouncing between that, 13, 14,000 range right there. And that was just a really healthy market. Everything was moving. Sellers were getting what they wanted. Buyers were getting what they wanted. Like things were moving. And we look at that 13 to 14,000 range. And as soon as we started going from 3,000 to 10,000, everyone started to panic about the number of homes on the homes for sale. But we can't lose sight of a bigger picture on some of this stuff. So it's going to help us tell the story to our consumer.
It was just a good, consistent time back then. And then COVID happened, and then lack of inventory, some of this rebounding stuff. So hopefully the trajectory on, we're just going to get back to those 16, 17, 2018 years. Here's just home for sale. Another way of looking at it, just how big a swing, when you're so low, but 180% increase year to date from where we were last year. Here's pending sales. This is just under contracts. Total under contracts in 2020, we had 62,000, dropped to 56,000, but we're at 40,000 in 2022. And you kind of see the trajectory starting out the year a little less than last year, which was that snapshot from the very beginning. But here's days on market, US days on market. We ended last month at 29 days on market, 34, 33. Again, that 30 number is pretty solid. Even these 14, 16, 17, just a little faster of a marketplace than we probably would hope. And then average days on market in Utah, year to date, we're at 64. Last year, we averaged 32, 23 the year before. And then you can kind of see right there, the last 3 months, we're pacing at 63, 67, 61. And now let's jump into mortgage rates. We've mentioned mortgage rates, but here is just the last 50 years of what mortgage rates have done. If you've never seen this graph before, it really brings perspective to kind of where mortgage rates truly have been. The historical average is this dotted line right here from 72 to 20. So when you include all these 80s years, no doubt the average mortgage rate over 50 years is 7.81. But still a lot higher than they are today. But if you look at just even the last 30 years, we're floating right there at 5.97, which is a lot more median where we're at now. But the historical average from 12 to 21, the heyday of low rates, hopefully you refinanced a property here or there, but 3.8 from 12 to 21, but even just last year, right at 5.34.
That's going to be the hurdle. If you look back over the last decade, the majority of buyers, both first-time buyers and really move-up buyers, they've really all been playing in the real estate space for the last decade. So in their minds, a 3.8 or a sub 3% mortgage rate is what's normal. They don't know the longer-term historical trend. Again, I think this graph is really helpful for them to see what that looks like. As you guys know, they're talking about one more rate bump in May. So there's a high likelihood we'll see a small bump again first part of May.
Well, and what I always say with this, because mortgage rates have such an impact on the payment, whether it's lower in it or higher in it, basically the 2000s decade right there, average rates right around 6%, when the purchase price goes from 200,000 to 400,000, but rates drop in half, it almost didn't let us acclimate to the rising of housing costs like authentically. It almost like kind of sheltered us from that. And then all of a sudden rates pop up. It's not that it just got expensive. It's just like almost like 2 decades of the housing supply, cost increase really just hit us fast.
Yeah.
And here's just the 30-year fixed annual rates. Again, you can see year to date, we're sitting at 6.37%. And then here's the line graph. You can kind of see on a month-to-month basis, just with some of the decisions and what the market does. We peaked right there, kind of coming into third quarter, dropped a little bit. We've increased a little bit the first quarter. But here's even just 15-year fix compared to 30-year fix, 6.43 to 5.71 on your weekly interest rates. And then we're going to start talking about the Fed now, the Federal Reserve, the Fed funds rate, some of the assets that they hold. I always just assume that the Fed funds rate, when they start monkeying with that all of a sudden mortgage rates systematically rise or fall with it. That's not always necessarily the case. You see the middle 2000s, we were pretty close, 5.25 to even 6.14. It was a pretty narrow gap between the Fed funds rate and what the average mortgage rate for a 30-year fixed. We got pretty far, but just look how long the last decade, even the last 14 years, we were near or if not at zero other than this little hump here. So it's just a tremendous time on the Fed funds rate, but you can see systematically as they've raised that over the last 12, 18 months, no doubt it has just systematically raised those rates, which I think everybody has kind of felt and seen. And then again, the Treasury bonds, you know, what the Fed Reserve does in cooperation with the federal government. This is the spread or the gap between a 30-year fixed rate mortgage and a 10-year Treasury. Just to put a little bit more perspective on it, historical average is about a 1.7% difference. We've surpassed that. You might hear of inverted yields. So as soon as that goes below, you know, sometimes that's the sign of a impending recession. But you can just see that spread there. But there's usually two things that the Federal Reserve, you know, the buttons or the gears or the switches they can do, but it's basically the number of assets they buy from the federal government, or it's their Fed funds rate. So you can see the purple is the Fed funds rate as that's risen up, but you also see in millions. This is only mortgage-backed securities. So it's basically those packaged up mortgages that they go sell in the open market. The Federal Reserve will go buy a bunch of those. They peak somewhere around the end of 2021. We've been decreasing. So they've actually been unloading those and selling them on the market. But just a lot of money the Fed Reserve owns, which they only start doing that, what, 2009 is what that says?
Yeah.
But then here's the comparison of just all assets. So, you know, about a third of the assets they own are the mortgage-backed securities. Here's what everything else they own, some of the other Treasury bonds and whatnot. It was going down, but even look at the last, 4 or 5 months, a little bit of a spike right there on them buying those Fed Reserve assets. So this is, me and Marcus talked about this one yesterday as well, but this is Mortgage Bankers Association. We're going to talk about mortgage purchase data, and then we do have a slide finally for some refinance data, but this is the Mortgage Bankers Association Purchase Index. So this includes all mortgage application for the purchase of a single family home. It covers the entire market, both conventional government loans, you know, and all the other loan products. So basically the index, a lot of these indexes are usually just where they started, or it's either an average or something. So I think this one's just kind of where they started back in the day. We were at 170 year to date on our mortgage purchase index. So crazily, if you look at 2014, we were right there, but really we just hit the lowest on the MBA purchase index than we ever have been since 1995. So everybody send an I love you text to your favorite mortgage people. They've had a rough go, no doubt, on the purchases, let alone the refinances. But here's kind of a week-to-week basis, drop down as low as 138. You know, some of those buyer remorse or those buyers not wanting to get in the market because of rates, no doubt it has created less mortgages for our loan officers out there.
And this is a good indicator of, it could be a good indicator of what we could project for sales in the coming months. Because a lot of times people obviously are turning in their applications for a mortgage, getting pre-approved, oftentimes before they even put an offer in on the house. So there's this piece going on that kind of can forecast for us closed units.
Yeah. So there's the index that tracks mortgage applications. This is mortgage credit availability. So just the overall mortgage credit available out there to United States borrowers, consumers. Basically, we're right at that index. So we've dropped, you know, even as banking deposits, new regulations, it kind of tightens up all mortgage companies' availability to lend or ability to go lend money out. You know, the heyday 2017, 18, 19, but right at that index. So 102, 100, 101 right there. But you could even see 2020 early popped a little bit. Here's kind of just showing the rates for the different products. You got conventional loans, government loans, conforming loans, jumbo loans, kind of just some of that data on the index. So here's the refinance data. So thank you, Gordon, for finding that. This was the story I was unclear about. We know they dropped, but how much did they drop? But this is the U.S. Mortgage Refinance Index, covers all mortgage applications to refinance an existing mortgage. Good gauge, overall gauge of mortgage refinancing activity. So again, 2021, look at that peak right there, 6,418 right there in March-ish 2020, right when COVID was happening. Also in comparison with rates, you can see just when we hit this bottom kind of trough right there, all those people refinancing. I refinanced a bunch of my rental properties, but as soon as they started raising rates, just looked at refinances almost fell to zero for a minute.
I think this will be an interesting story over the next couple of months, is because I think one of the biggest determiners of what happens in our market is what people choose to do with the equity in their home. So if their savings is diminishing, but their spending habits stay high, the next thing they're going to lean on is credit cards or the equity in their home, which we may even see. We're actually seeing it a little bit right now. You see that little bit of an uptick in March. Is some people choosing to refi right now, even though rates are high, it's because they need the liquidity of the cash for something, right? Whether it's for an investment or for a consumer. But that's going to be a big determiner of our future economy, not just the market, is what people choose to do with the equity in their home, which is a big differentiator from the story of 2006, 2007, because the equity was stripped from everyone. Everyone had reverse equity in their home, where right now people on general have some element of equity in their home. So this is going to be interesting. And then the longer rates stay high could forecast one of the biggest refi booms our country's ever seen in the next 18, 24, 36 months as well.
Totally. Yeah, we had a mastermind for a lot of our top producers in our More Club, our Platinum More Club last week. And one of the questions I asked them was to vote. By the end of the year, do you think rates will be higher than they are now or lower than they are now? And 100% of the agents in the room voted that rates will be lower than they are today by the end of the year, which means two things. Either A, it gave me tremendous confidence that our smartest people in our company see the data and they're anticipating it. Or number two, we're just the most optimistic people in the country because we're realtors, and I guess we have to be, right?
Well, the good news is I read an article this morning and the Fed's voting the same way. They think September they'll start seeing some softening.
Good. And we'll look at inflation data, which has kind of given them the confidence to hopefully bring that rate down a little bit. Here is, we just barely started tracking this last quarter to kind of, a lot of people mention this, but what really is going on with foreclosure activity and foreclosure rates. Foreclosure filings during the first quarter of 2023 were up 6% from fourth quarter 2022, but they were up 22% from a year ago. So this is just foreclosure rate percent of all housing units. So there's a lot of housing units out there. We peaked at 2.23% in the foreclosure rate. Clearly, we're just very low decimal point. Another stat that we tracked back then was just percent of active listings were foreclosed properties, which is a lot higher stat, no doubt. But you can see quarter one, we were at 95,000 foreclosure filings, which all of last year were 324. So even if we keep on this pace, we'll probably end somewhere around 400,000, which no doubt will be a little bit of an uptick, but still nothing dramatic. But primarily that's based off just the amount of sellers that have decent equity that's, preventing foreclosure situations, even if they get behind on payments.
And this goes back to my comment just a minute ago about what people are choosing to do with their equity. This could be a result of some of those people that had some element of a forbearance on their mortgage payments, rode that wave as long as they couldn't catch up. And this is a result of that.
Because right when COVID happened, forbearance was a very loud word in our country, right? And there was millions of people that did put their loans into forbearance. So there was talk that we were going to see this huge chunk of people coming out of that forbearance, which I think was a lot lower than some of us may have thought, which is, hopefully a great stat. So let's talk about affordability. When rates go up, prices go up, it becomes less affordable. Our peak on this index, a ratio of 100, indicates that a median family income is just sufficient to purchase the median priced home. So you look at 2012, after the recession, prices dropped, rates were really good. That was the peak that we've had the last 20, 30 years. But even just the last couple of years, as prices just rose up so fast, but also when you take the rate increase, we're right at that index. So basically, on average, across the country, the median family income is just sufficient to purchase a median priced home. And you can see just month to month, we were still pretty decent before that COVID run. And then it kind of just systematically decreased almost every month, still right at 105, 104 the last couple months. And then Utah, because prices went up a little bit higher. We do have a little higher income on average than the United States. But I think our purchase price rose a little bit higher or faster or disproportionately to the income. So again, our index, we are low, and we've been under that 100 for over 2 years, 73 in 2022. As prices went down a little bit, even though they've gone up the last couple months, we still are a little higher than we ended up at 2022. And you can kind of see that ratio, but the first 3 months we're on a downward trend. So 83, 79, 77.
Again, you just with affordability, I think this is one of the most important scripting things we need to learn as agents. Is a lot of the blanket statements we're hearing from the consumer is it's too expensive. I'm going to wait for prices to come down. I'm going to wait for a crash or whatever it is. All of those could be redefined as an affordability topic. And generally, as you mentioned, Johnny, there's 3 pillars to the affordability conversation. I think one of the best things we can do is hear what they say and pull it back to which one of those pillars are they basing that sentiment off of? Is it around mortgage rates? Is it around their personal income and their ability to afford it? Right? Or is it actually do with pricing? And let's talk about long-term trends. But a lot of times we're just too quick to agree with our clients other than saying like, well, tell me more about that. All right, well, that has to do with your personal income. That has to do with interest rates. Let's talk through that of what does that look like today and what is the trajectory of that?
Because even our builders, they're trying to help solve this gap in the affordability, but they still have the 3 challenges too. It's the land costs, right? And a lot of farmers and landowners, like they're having a hard time budgeting on their prices, even though we've seen a little bit of decrease in that. We talk about the supplies, the supplies that it takes to go build a home. We've seen some of those come down. There's some of them that are kind of sticky. And then you got labor costs as well, which I built a home probably in the worst time ever just because the labor costs were so high because of how fast things were moving. So time out real quick, just to let everybody know before anybody jumps off at the end, there's 2 locations. So we always record this, number 1. So if you ever want to come back to this and see how awesome Marcus is, go to kwutah.tv. That is our YouTube channel that will have this posted after this event. And then also kwutah.com, you click resources, and Gordon also puts the PDF of this market report. So we spent a lot of time on this, and we really do hope and challenge you to use this throughout the quarter. Before our next quarter update, you should print off some of the most relevant slides for your buyer presentations, your seller presentations, share them with your kids, share them with your spouse. Just kidding. Maybe they won't care. All right, so let's talk about the rental data. So here is Utah yearly average rental rates. So some of you that own rentals, or maybe some of your renters that out there wanting to buy, we've seen just a consistent increase on average rental rates. Yellow, you can see, is our Weber County, Utah County, Salt Lake County finally surpassed last year Utah County from the year before, which was surprising me. Utah County had a higher average rent rate than Salt Lake. But again, Salt Lake passing back up last year at 1,623. And then your blue is Davis County. But here's your average rent increase. So Gordon kind of put some comparison from 2018 to the end of 2022. Weber County's rental rates went up 63%. You guys crushed it up there on your rental rates. Utah County up 34%, 40%, Salt Lake, Davis County 38%. But even just from 2021 to 2022, that was a big pop year where you start seeing rents go up a little bit. Weber 11, 7, 9, and 7 for Davis County.
This is the challenge in the marketplace is if you have a first-time buyer or a buyer in general that is looking at a home and saying, man, that interest rate's too high, the mortgage payment's too high. When they say no to that, they're saying yes to a very high rent rate or moving in with mom and dad. So it's a lot of times they don't make the connection at first to say, oh, that mortgage payment's too high. I used to rent that house for $1,100. I'll just go do that again. But that $1,100 rent is now $2,400 a month rent, right?
Mm-hmm. Yep. Yeah, in 2008, I was a newlywed. We rented a 2-bedroom, 1-bath apartment for $440.
I remember that. I was your landlord.
So rude. Fix the heater, okay? Here is Salt Lake City average rent. You got studios, 1-bed, 2-bed, 3-bed, 4-bed. You can see year to date. Here is just Salt Lake City average. This is one of the reliable sources that we have. Year to date, $2,755 on 4 beds, but your typical 3-bed, 2-bath is $2,287. You can see here 2023 HUD. So HUD has several rental assistance programs that they contribute some of the federal money to subsidize or pay rent for some of the people that need assistance. They always have to set some sort of bar on what they're willing to pay in rent across the country. Here is basically what they sent for 2023 on those HUD fair market rent levels. So 2,061 for a 3-bedroom, which again is under what the actual average rents are. So there is a little bit of a gap there. But here is basically the fair market rent set by HUD for federal housing assistance across the state for the 2023 year. So you can see Utah County right there, 1643. You can see Summit County, 1890. See Weber County, look, Weber County is 1734, Utah County is 1643. How are you guys higher rent than we are in Utah County? Don't you have gangs up there, Marcus? Just kidding.
Well, and the important thing on that one is how they set this. It's dated 2 years back. So this data is really old and it's not keeping up with the pace of rental increases based on what people are buying at the current interest rates.
Yeah. Are you saying the government's slower than the market?
Yeah.
Surprise, surprise. I will say, because with my property management company in Arizona, we manage several hundred properties down there. We are seeing for rentals days on the market increase a little bit as well, and rent prices soften slightly. So that could be a trend coming up where we were pushing rent prices. We might see those, which is interesting. If the mortgage rates are making it more expensive to buy a home, normally they'd go to rent. Now, if we see rental market softening a little bit, we're going to see more and more multifamily situations in either coming together and buying a home or moving in with family. Like that could be a very high likelihood we see a big increase of that over the next couple of years too.
Yeah, and you'll see this the slowdown in this in the next couple slides.
Yeah, because even inflation, right? Some of the inflation indexes that include rent into it, rent can be one of the biggest contributors to inflation or deflation. So if rent does actually come down, hopefully that's a positive thing in some of those inflation numbers. But here's cost burdens for the Utah's 6 largest counties. The blue is share of housing units that are renter occupied. So you can see in Salt Lake County, 33%, basically straight at 1/3 of all housing units are renter occupied. And then that orangish color is share of renters that are cost burdened, which means spending more than 30% of income on housing costs. Looks like Cache County up there is the highest, 36% or 45% of renters are cost burdened, but the top one's Washington County, actually 49%. Of renters are cost burden, which more than 30% of their income is going to housing. Utah County close behind. Davis is doing the best, but still 41% is a big number.
And this is a big, like, again, looking at everything, all these statistics don't tell the whole story, but if all these tenants are cost burdened in housing, remember the rest of their income is also spent on other things. And with inflation, they're cost burdened on those things too. So there's a handful of people feeling a major pinch in the marketplace that's just being fueling the fire, particularly with the housing market, but it's not unique to the housing market.
Yeah, and a lot of this data is just a little bit of a prediction of what government assistance programs are going to start coming out, right? You've already heard of one that's a $20,000 credit for buyers that are buying new construction builder ones. They're trying to throw a little bit of money in the state at spurring the builders. You remember some of the tax credits and down payment assistance programs that were there after the recession. So you should be paying attention to your state and federal, buyer assistance programs. But here's just in general the 2023 Utah housing profile. You can see that 19% of renter households are extremely low income. Right now, the latest projection is that we're about 43,623 rental homes that are affordable short right now. So if you want to go build some affordable rental housing, that is a great spot to be. Maximum income of four-person extremely low income households. But you can even just see here, low income rental households on a pie graph, 26% are disabled, 38% in labor, 25% senior. Housing cost burden by income group, depending on low, median, very low income. And then
this is one of our biggest challenges in the market is any investor like me looks at this and says, oh, I need to go build affordable housing. Well, the problem is the cost to build multifamily is so high right now that the rent you would have to get to cover it, you can't make it affordable. Just it's an interesting pinch on the market.
which hopefully continues to drive the innovation in the building of, affordable homes, bamboo. Do you know bamboo grows overnight? We can just figure that connection out. They did this at family reunion. You can look deeper into this, come back to it, but basically it's comparing, someone that's owned a home the last decade from someone that rents and invests 100% of the difference between their rent and their mortgage payment or the other costs associated with owning a home, and they dump that into the stock market, or even someone that rents and invests 10% of their savings if not owning the home. So again, clearly, over time, no doubt, owning a home is substantially more profitable, equity bills, net worth building than renting, right? And here's what Gordon was talking about: the United States rent growth, year over year change. And again, you got markets cruising up still, cruising down, flatlining, but overall rent growth as of last month was 2.8% increase. So we haven't gone backwards yet on average across the country, but we're getting pretty close to that zero line, but 2.8%. And here's even just a month over month change. You saw the end of last year, we did start going negative, but because of the increases the first half of the year, it kind of just ruled them out. But even just the last couple months, we've already seen a little bit of rent growth in the United States. I heard a stat that during the Masters tournament, that 50% of the Airbnbs down there in Phoenix went unrented. Did you hear that stat?
I haven't heard that. That's crazy though.
U.S. new build for rent, 2 or more units completed. So when you build something immediately for rental, not you bought a property and then maybe ended up rented out. This is a lot of our apartments constructed, but you can see 28 years right here in the middle. We had 28 years below the 48-year average. So just a tremendous gap in homes built specifically for rent. You saw the number that we were short in the state of Utah. So I can't imagine how big that number is for the United States overall. This is old, this is 2021, but we still like to show it. As soon as we get this updated, it'll be nice. NAR hasn't put this out, but at one point, 16% of all buyers in the state of Utah were institutional buyers, these capital groups, these hedge funds, which about 1 in 8-ish were getting bought by those institutional buyers. I do think that's probably dropped as the appreciation rate slowed. But here's even rental vacancy rates. When you look at the other side at our vacancy rates across the country and in the state of Utah, it's funny because I started buying rentals in this phase right here, 2009, 2011. So every time I do a rental analysis, I still put 8% as my vacancy rate on my pro forma. But we've been well under that for a long time. So purple's the state of Utah. We finished the year last year at 4.5% vacancy rate across the board, whereas 5.8% for the United States. Again, a balanced one is 7%. We continue to be under that. State of Utah has been under that for about eight plus years already. Any other comments on rental properties, investments?
The only thing I'd say on rental properties is any market is good to buy in. I've never bought a property that I look back and be like, man, I wish I wouldn't have bought that. Like in both up and down, as long as you understand the market, what you're doing, I made an offer yesterday on another rental property. So I encourage this group to play in the space where we're the experts.
Yeah. 5 years ago, I wish I bought more rentals. 10 years ago, I wish I bought more rentals. 15 years ago, I wish I bought more rentals, right? There's never going to be a time that you won't have that regret looking back.
Yeah.
We're going to go over GDP, unemployment, real wages, definitions, and inflation. But here's the real GDP. So gross domestic product is basically the total accumulation of all goods and services that the United States has, which is a number that the federal government tracks. Are we just growing or are we shrinking? 2022, we grew 2.1%, 2021, 5.7%. You'll see the month to month, but clearly we went backwards with COVID so much. Look at that swing, Q2. It felt like we truly fell off a cliff. COVID happened. Everybody locked down. Everybody started ordering spaghetti sauce and food storage because you thought it was the end of the world. Basically, our economy just totally paused for a second. But the quickness and the speed at which we rebounded was no doubt monumental. We'll look back at that time period 50 years from now and just think how crazy that was. But usually a good solid, 2%-ish a year is good solid GDP growth. Q1, we were up 1.1%.
The only question I have on going back to that is of that recovery in Q3 of 2020 of how much of that was actual normal growth versus over infused of cash flow that then converted to increased GDP that may have reflected into some of the problem we're dealing with today.
Yeah, what was it? $2 trillion we printed in that time period. So no doubt that had a major impact, which looking back, I still think the government overall did a good job with that. I think they might have overstimulated it, which has caused some of the problems, but had they not thrown some cash at it, like who knows what would have happened, right?
Yeah, I think they took the right, and I'm worried they're doing the same thing. And not to turn this into a political discussion, I think they took the right actions, but too much of it. And I'm worried that in trying to recover, I think they're taking the right actions. I'm worried they're taking too much of it again, right? So it's a lot of times you have to, you make a change, you have to watch how it reflects into the market, and then you modify the change. So it's interesting. It'll be interesting to see if there's some overreaction and overaction taken in trying to correct our market, where they're talking about it could be a soft landing where we're about to bounce at a moderate GDP, almost balanced market, but it could topple us into a recession too if it's overdone.
Yeah, which Gary Keller says they always get it wrong, right? Like they get it close, but when they're trying to stimulate it, they always tend to overstimulate it. When they're trying to curb the growth, like they have been the last 6 months, they always kind of curb it too much, But yeah, and it's a big country, which I can't imagine having that job anyways. But here's unemployment across the country. We finished last year at 3.6% unemployment, which is just really low, really healthy. This has been the crazy number for me, even after looking at the last 9 months of how a lot of stats have changed, how consistently low our unemployment is. But again, you look at the United States, COVID happened, right? We went from 3.5, 4.4, all the way up to 14.7% in 1 month. Our workforce, if you look at the country, is about 165 million people. So the fact we jumped 10% in a 30-day period means 10%, which would be over 16 million people didn't have work overnight, basically, which is crazy. And then we recovered from that within a handful of months, but still a lot of chaos happening. Here you see the overlap between unemployment rate, which is that purple line across the country, and then the other one is job openings. So this is the amount of job openings. Some guy in Washington, D.C. goes through KSL ad after KSL ad and just counts them all up. I don't know how they do it, but I thought
that was Gordon that did it for this graph.
Gordon counts to 10 million every month.
He runs out of fingers.
Well, this is the one that I have a little hard time, believing. I know all the tech companies make front page headlines. Oh, this company laid off 6,000 people. But when you talk about millions of workers, it's such a small drop in the bucket. But because they're such well-known companies, they like to make the headlines. But it is crazy to me that we haven't dropped openings at a faster rate than we have the last couple months. The fact that we still think we have somewhere around 10 million job openings is a very healthy sign. Unemployment staying solid is a good thing, which is also why they had a hard time calling what we went through on the GDP decrease in 2022 a recession, just because of the cooperation of such a low unemployment. Didn't really feel like a true recession when we had a couple of those quarters.
Yeah. One of my concerns to watch this forward is generally in a more restrictive fiscal environment that it de-incentivizes entrepreneurs, and entrepreneurs create a lot of jobs. At some point for an entrepreneur, if the incentives of being an entrepreneur go away, that they decide, hey, I'm just going to go take that job at the bank. They're now competing for an open job in the market, but they're also taking several job openings off the market. So this could be really interesting over the next couple of years if some of those incentives to be an entrepreneur get taken away or diminished. How many of those jobs will disappear, decreasing the number of jobs available, which then could increase unemployment.
Yeah, I read an economist report the other a month or so ago that talked about the balance of inflation versus unemployment. And their perspective was that you actually have to see unemployment go up 2% for every 2% that you want inflation to come down. So if we really want inflation to continue to go down, unemployment naturally is going to go up a little bit. So the fact that it stayed the same and we made a little bit of progress on inflation go down is kind of abnormal, to be honest. Here is U.S. Census regions, job openings. So you can kind of just see year over year from February to February. The West down 20% in job openings. So you have seen some of that, the job openings kind of disappear, but a change in job quits basically means someone's quitting and going to another job, kind of the change in professions.
Well, and
employers.
it also shows that those people that were job hopping are no longer doing it.
Yeah.
That's the comment I was going to make. We
That
talked
big,
a lot about
that big
great
quit
resignation.
is not happening.
Mhm.
This is good news for employers because there was a lot of that job hopping, kind of holding people hostage for higher pay. So it'll be interesting to kind of see how the result of that great resignation and job hopping results in the market now.
And this is a really accurate report because they base it on your W-2.
Yeah. Well, even last year, I was considering quitting my job to go be a Navy SEAL, but luckily they said they wouldn't take me. So here I am. The real unemployment rate. So U6 includes underemployment, marginally attached, and discouraged workers. U3 is what you typically hear in the news. So U3 you can see is at 3.6, but when you actually include people that are underemployed, that would prefer to be more employed. Marginally attached, you can decide what that means. And then discouraged workers clearly just adds about 3% to that unemployment rate. You kind of see how that goes month over month. They pretty much follow each other. This is the annual labor force participation rate, is the number of all employed and underemployed workers divided against the civilian population. So basically in the United States, 62% of our population work or are considered in the workforce. Utah, we tend to trend a little higher than them. And then here is the real average hourly earnings month over month. So again, this is real average hours. So this does take into play inflation. So even though our incomes were going up the first, several months, it didn't feel like it because again, inflation, would happen. But let's talk about inflation in general. There's a bunch of ways we track. Gordon is just a total genius on a lot of this stuff. But again, the main two, we call them headline. CPI, the headline, this is what you'll hear on news media. This measures the monthly change in prices paid by U.S. consumers. This does include energy and food, which energy and food is traditionally considered to be a little volatile and somewhat uncontrollable if we're importing a lot of that stuff. Core excludes energy and food. So it kind of removes the volatility. There's another couple places that we track. There's flexible inflation and sticky. So basically just depending on what categories you put in to track the price increases or decrease will give you a different definition. Flexible means it's kind of including goods and services that the price changes frequently. There's a lot more volatility, where the categories that are considered sticky are a lot harder to move up or down. So you kind of just see the differences as we go through these slides. But you can see the mainline one that includes energy. We made a lot of progress. We peaked at 9.1. We brought it all the way down to 5%. But again, when you remove energy and food, that is big up and down swings, it's been a lot more consistent and a lot more difficult for us to truly get that down.
One comment that I'll make on inflation in general is we're looking at these graphs too. And I think the majority of us know this, but I've gotten comments from several agents and a lot of the consumers that misunderstand this downward trend on inflation. It's just like using this as an example, we had an inflation of 9.1, meaning that everyone knows that their cup of Starbucks when they drove through was more expensive. Now they're seeing this, oh, inflation's going down. They think that means that the cost of their Starbucks coffee is going to go down. This is 5% increase measured from a year ago. So on an already inflationary price, it's still up 5.6%. So the good news is it's decreasing, but it's not, the inflation is decreasing, but the prices of our goods aren't coming back to where they were.
Yeah, totally. Until we see a negative number, things didn't get cheaper, no doubt. And then you got the whole, what's that called? Shrinkflation. You heard that term, where it's basically like the size of products or the amount of chips in a chip bag have actually been decreasing, as well as prices have been going up. So the actual value component potentially could have changed. But again, projections, here's kind of their projections. They really are hoping somewhere in the middle or whatnot of 2024 that we'll have gotten both of those core and mainline inflation numbers down to 2%. 2% is, again, what we consider our target or our consistent ability to trend that line.
And again, notice there's no projected negative of price recovery. I'd like, in some ways, we've got to accept the new price of things is some element, the new price of things, unless we see some negative numbers on there.
Yeah. And again, we just want incomes to outpace the price increase of goods, right? But
Yep.
again, we're still incredibly blessed in the United States. Like until you study other countries and continents, like you don't realize how good our inflation actually is. And again, until I actually got involved in Argentina, I didn't really understand it, but they've actually consistently had 80% inflation a year the last several years, which is just crazy to think. That's really how economies end up collapsing, as just a repeated time frame of that. But here's affordability in perspective. You can kind of see a car. 1989, $15,000 was the median car price. 2023, it's right around $50,000. Adjusted for inflation, that same car in 1989, just following the inflation trend line, would be 37%. So the real change from 1989, cars are 30% more expensive. Gas is 47% more expensive. The price of a home is 61% more higher, 17% on wages. But again, even though our rates have gone up in perspective since 1989 because of how high rates were those couple decades, our mortgage payments are actually equivalent, still lower from 1989 real change, which is crazy. And again, before rates went up, that number was such a decreased number. And thank you, Gordon, for doing this. I really like this one. This is year end 2022. Basically from the year of 2000, have prices of things gone up or down over the last 22 years? TVs, remember how expensive TVs were? That is such a true stat. They're down 97%. One of those big old ugly things were $20,000 or whatever it was back in the day. But clearly that's gone down. Toys have gone down. Computer software, cell phone services, clothes barely. New cars over the last 22 years have only gone up 24%. And really, it's just been the last several years. Housing.
Go ahead.
I just say housing's up 87%.
I was just laughing at this graph when I was looking at it, just because the timing of my life back in 2000, 2002 with my little kids at home, I was paying more for toys, and now they're all going off to college. And look what college and textbooks and everything are. It's like someone's working against me here, timing wise.
Which, not to get political again, but you look at childcare, you look at hospital services, college, all that thing. Like one of the things we have to solve in our future is somehow making it more affordable for people to have children, right? Which is what usually causes the reproduction rate to decrease or go negative, is the cost of kids. People just say, oh, nope. The average I saw the stat the other day, the average kid from 0 to 18, the updated number is about $330,000 it's going to cost to raise from a baby to an 18-year-old. Crazy. Here's the CPI changes, but again, interest rates, huge increase, real median home payment, rent increase, some of these other ones, March 23, a 12-month change. We've seen gas actually go down because it really went up the first quarter of 2022. Even food, these used to be bigger numbers. We're finally seeing food slow the rate of growth. Eggs, the egg craziness, eggs are a little bit almost back to normal, hopefully. But here's your
again with our consumers looking at their budget. If they're feeling a pinch on their budget, they're going to look at all their consumables and say, where can we have the biggest impact on reducing our budget? And it is our industry. That's not buying less eggs isn't going to get them out of debt, but they'll look at the biggest expenditure. And that again is looking in our space. We need to be better at creating solutions for them that help that. So it's just interesting to see that our industry has had the biggest impact on that inflation piece.
Yeah. And 20% of the realtor population drive Teslas. So you can see electricity's affecting them a little bit more than the gas is. Just kidding, I made that stat up, but it's probably close, 20% Tesla drivers. Here's your flexible and sticky CPI. Flexible, so again, a lot of those more volatile numbers, you see how right back to that trend line it's gotten. But again, those sticky, harder to move categories of goods and services, we really haven't seen any progress the last 12, 18 months, even on those sticky ones. A previous life, Gordon was a purchase manager. So he managed a lot of different purchase things. Again, when you look at the supply chain of goods and services, you got manufacturing, you got, orders from retail establishments, and a lot of them, they have to do their own set of predictions on what they think the market's going to be like 6, 12, 18 months from now. You think Target orders their Christmas supplies the 30 days before that? No, like they're clearly doing that really far before. But the PPI, the producer price index, you can see that's really kind of slowed, but you're still seeing a positive growth number, 2.7% as of March. And let's just even talk about personally, right? Gary Keller says you will not see inflation move until you personally are starting to question some of your financial decisions. Like you yourself are choosing not to go on the vacation, not to go buy a new car, right? But again, here's real personal consumption expenditures by quarter one. Again, we went up 3.7% in our personal expenditures. Here is the market-based personal consumption expenditures, which excludes food and energy, up 4.7%. So people are still spending money, but where's it coming from? This may be a sign, but our revolving consumer debt, our use of plastic and debt and credit cards has hit an all-time high, which the numbers in billions, what is that? $1.2 trillion of consumer debt. And then this is the other one we got to be careful of is the annual personal savings rate of disposable income. Again, our disposable incomes kind of felt like it evaporated because stuff just costs more, but the percentage of disposable income that we actually end up saving, we have gone up a little bit the last couple of months, which is good, but even just after the COVID panic, look how much of our disposable income just went and socked away into our savings.
I think that graph and the one before is going to be a really interesting story to tell. I made the comment earlier that a lot of what's going to happen in our economy is going to be based on how people treat their equity. Well, a lot of this goes back to their spending habits. Is if people's spending habits, they want to maintain their new spending habits because of the influx of cash they had over the last couple of years. Well, if their income's not producing it, then they're going to lean on their savings. When their savings are gone, they're going to lean on their credit cards. When their credit cards are maxed, they might lean into the equity in their home. It depends on how much pain they're willing to go through before they change their spending habits. And so that's we already seen that pattern show up. Savings have gone down, credit card debt has gone up. Will we start seeing them lean into and take the equity out of the home, potentially increasing for the number of foreclosure notices? Somewhere in there, these consumers have to feel enough pain to be like, all right, I got to change my spending habits.
Yeah. And the speed at which we change them, right? Because usually your income can change in a month, but it might take 6 months to change your spending habits. And we just got to get way better at changing our spending habits as fast as income potentially can change, right? Here is our deposits of all commercial banks. So this also is what affects mortgage credit availability. But this, you could see just the deposits down 4.9% in quarter one. Whether people are needing that money to go out and live, or this could be a little bit of the fear in the banking system with a handful of those banks going under, that people are pulling them out, putting it under their mattress, right? And then here's manufactured durable goods. This is new orders. So this is manufacturers that manufacture stuff in the country. What's their new orders in millions? So again, all the new orders of manufacturers has not tremendously decreased. It did for a month or two, but again, still pretty healthy on projections of how much stuff they think we're going to need to buy or use. Here's the PMI, the Purchasing Managers Index, new orders, just another way of kind of looking at what's going on in the manufacturing. Here's kind of Gordon's summary. Mainly, you just want to look at the direction or the rate of change. But in general, supplier deliveries, inventories, employment, production, new orders, prices, backlogs. Even last quarter, we didn't see as many contracting. But you can see overall, it's not huge. You see kind of low single digit percentages, but still in general, you're seeing a little bit of contraction on what they're projecting, the sales might be. Advanced retail sales percentage change. Again, that hasn't really necessarily hit that, but still a positive number. Gordon, any comments on any of those purchase index, manufacturing index?
Well, the inventory is a big thing because I think they over ordered for such a long time that now we're just catching up to that. And that's why that number's like so many months behind.
Mm-hmm. Yeah. And again, because profits maybe have eroded a little bit with just, the economy in general. So they may be willing to take a little less risk on how much inventory some of these places carry. Could also be why we've seen some contracting in the manufacturing.
Yeah. They're going away from just in time.
Yeah. Index of consumer sentiment, just how happy are consumers out there on an index. We kind of bottomed out right there at the 50 number. We have seen some increases the last several months, but even just 2019 right there at that 100 index level. This is one that Gordon tracks called the misery index. How miserable when you actually take inflation and unemployment into effect, a lower number's better. Right after COVID, we hit 15. We even peaked at 12.66 right at the middle of last year. But the downward trend, no doubt, is a positive sign just on a kind of an emotional with stats data right there. Kind of see month to month. So let's try and compare that to the Utah economy. We'll go through some of these. Again, some of the records we hold: 4th highest median household income, 6th lowest unemployment rate. We have the 3rd highest labor force participation, 2nd lowest poverty rate, largest household size. Good job, everybody. We are also still the youngest median age out there, and the 16th most favorable annual employment growth. Let's skip those. Here is our yearly unemployment. Again, we just tend to trend underneath the unemployment ratio of the United States. We're at 2.1 ending last year, where the federal stat or the nation was 3.6. Here's our trend line month to month. We finished March at 2.4 months of unemployment, which is just a really, really low number the last several years.
So low, it's crazy.
Here's the GDP of Utah, just each year, no doubt we're growing. And again, this is just growth in those sectors, but one of the big factors too is just the net migration constantly being positive. We traditionally are somewhere around 50,000 net migration, more people move in than out. Here's your GDP year over year change. Personal income growth, we tend to outpace the United States, on this a little bit. Q4 2022, you can see Utah was up 7% in personal income growth. Really just that one quarter went backwards, but in general, our income has been growing. When you have high inflation, it feels sometimes like not. So if we can keep this trajectory, because for the most part, look at the last decade, that's pretty healthy income growth. We just got to make sure we curb inflation so it feels like we made more money. And then let's just try and hit construction and then probably start wrapping it up. But here is the 13 years below the 1 million average. We should be building at least 1 million homes in the country, which we did in 2022 and 2021, barely last year, but we went 13 years below that. So again, 5 to 7 potential million homes underbuilt. You can see we kind of were in the heyday before the Great Recession, which is why we fell underneath that. But here is just Utah. So the yellow and the yellow line is kind of the trend of builder permits. So this is when permits are pulled to start them. And then the purple is units coming online. So occupancy permits. So that's where the actual housing's being built. You can see even just really healthy numbers, 2021, 2022. But this decrease right there is just a little bit of the timidness of builders wanting to go keep, buying projects and developing.
There's a bigger lag on this too, because you think about the homes that are actually hitting the market today or even started today. The developer started that 24 months ago in the process of buying the land, develop. They had this forecast all the way till now. So we'll see some products coming on the market because a builder has to bring them to market because they've already gone down this path. But are the developers going through the process with the city for the next element of product coming on the market? In 18, 24, 12 months from now, it'll be interesting to see how many new products are coming on the market then based on builder sentiment today.
Yep, totally.
Yeah, and the other thing, you can go back to the 2000s and you can see that a lot of it was single family. And you go to now and that entry level home is now a condo or a townhome. So the number of units per start has considerably risen.
Yeah. And even just that you look at the builder permits, right? A drop from 21 to 22 is probably a reflection of a drop in units coming on the market in 2023. Just not a lot in that construction process. But here's overall just housing starts in billions. So this is the volume. 2021 was the peak, 7.1 billion last year. Here is the U.S. price indexes of new family homes under construction. So again, 23, that index was the highest. another way of looking at it. But here's builder confidence, which you just alluded to. This is kind of just a continuous survey of the confidence builders have on building and building in the future. We really got low right there at the end of last year, but we've since risen up. We're at 44. But here's the year over year change. So basically starting out this year compared to where we were the first 3 months of 2022, we've dropped 50% in that builder confidence, which probably feels about right, just because that first 6 months of last year we were humming. And that's it. So we do have these. You guys are welcome to visit these. These are, some of these are updated, some are not, but these come straight from Keller Williams, just on kind of some of the other things going on: new homes, distress sales, new listings, volume per agent, sides per agent. So, all right. Final thoughts. Let's start with you, Gordon. Any final thoughts you want to throw out?
Even though some of the stats look really scary, I think that this is going to be a really good time to start looking for deals. There's going to be some really good deals coming aboard.
Yeah. Marcus, final thoughts?
Yeah, I would say that, I've had the chance to go teach in a lot of market centers across the country right now and try to understand their market when I'm there. It makes me really grateful that this is the market we're playing in. There are so many positive things about the Utah economy that is really a positive thing for us in our business. The other thing I would say is there's the last decade, the consumer thought they knew everything about our space. This is one of the coolest opportunities in what we're doing right now is the consumer, everyone in your database is living in a little bit more of a place of uncertainty and they don't know. And this gives us an opportunity to take this information and say, now, how do I take this and connect with my people and add value? And it's going to increase your relationship with them if we choose to do so. If we don't go to our consumer and have these conversations and educate them, then someone else will, and we're going to give up that person or be that valid person for them. So this is a huge opportunity, even though it feels different. It's a huge opportunity for us to elevate our game and recapture more market share.
Yep. Well, thank you so much for being on today. Please review this data, share it. There's a lot of work that goes into it. So thanks for being on here. And again, when I look at this data, I learn a little bit, but when I go out and teach it or share it, it tends to retain a lot higher. So go out and share it a couple times the next several weeks. Thank you for being on. Again, we'll do this every quarter. So after Q2 closes, we'll get it booked and we'll have you all back on. So thank you and have a fantastic weekend, everybody.